What's up, guys? How's it? It's Homer Tipton here. In this video, I'm going to share with you exactly how to create a long-term real estate plan to escape the rat race in 20 years. I know that might sound like a long time, but it's less than the default. The default method is a 40-year plan. If you're just getting out of college at 22 and you plan on retiring at 67, that's actually a 45-year plan. And I'm going to cut that in half right now with the 20-year real estate plan. And basically, it's simple. You buy 2 houses every single year for 10 years, and you put all of them on a 10-year note. Are you with me? So basically, this year, let's start this year, buy 2 rental properties, okay, and put them on 10-year notes. But buy them in such a way that the rent pays for the notes, pays the mortgage, the taxes, the insurance, your vacancy rate, and pays for any maintenance that may need to be done on the property and any management that may need to be done on the property. Because you don't want to manage these properties and you don't want to fix them up, so you're going to want to pay somebody to manage the properties, pay someone to maintain the properties, which would be your management company. And basically you would just be the investor. So you put it on a 10-year note, and let's just say, throw a number up there and say it's a $50,000 house. So you buy 2 $50,000 houses this year, and you do that every single year for 10 years. Okay? At the end of 10 years, you have 20 houses, and 2 of them are now paid off. So now every year you have 2 houses getting paid off. Now think about that. Let's just say you rent the houses out and the mortgage payment and everything is I don't know, $700 a month. So $700 a month. Now you're getting $1,400 a month in income now that the houses are paid off. See where I'm going with this? At the end of 10 years, you're going to have $14,000 worth of income. That's if you don't have to raise the rents, which in 20-year time, you would raise the rents. And let's see, the values of the properties, let's see, it's $100,000 and you bought for 10 years, so it was $1 million worth of properties that you bought. But now, 20 years later, the markets went up, you get more for rent, and your properties are worth more. Now, of course, there's no guarantee, but we all know with the monetary system that we have right now that property values have always gone up. The Dow Jones always goes up. It's at an all-time high. Prices of houses are pretty much at an all-time high. So, the way it's been throughout the last maybe almost 100 years now or so, the price has always gone up. So, chances are that $1 million that you invested, which you really didn't even invest because you borrowed the money from the bank, so you actually leveraged your way in. So your $1 million worth of property might be worth like $1.5 million because you actually bought smart and you bought right, and you bought good deals because you paid $50,000 for houses that were worth like 70 to 100. and so now your properties might be worth like $2 million. So if in 20 years, if you had $2 million worth of houses and $14,000 a month in income, do you think you could retire then? Okay, well, then I think maybe just go and get you a house and start looking for a house to buy. If you need any help, holler at me. I'll see you in the next video.